Hi, I'm Shirley. To ensure that revenues and expenses are properly recorded under an accrual basis, accounting information systems use adjusting journal entries. The process of recording and posting adjusting entries is the third step in the accounting cycle and occurs at the end of each accounting period after the trial balance is prepared. Adjusting journal entries are entries made in the general journal to record revenues that have been earned but not recorded, and expenses that have been incurred but not recorded. Therefore, there is no cash involved when recording adjusting journal entries. I'm going to talk about 4 basic scenarios that explain why adjusting journal entries are necessary. Scenario 1. Deferred revenue. Companies sometimes receive cash before they earn revenue or provide goods or service. For example, a company received $2,000 from a client for service to be performed in the future. At the end of the accounting period, the company had performed 50% of the service. Therefore, we debit unearned revenue account and we credit service revenue. Scenario 2. Deferred expense. Companies often pay cash before they incur an expense. One of the examples of this scenario would be depreciation expense. Depreciation is a process of spreading out over their useful lives the cost of non-current assets such as equipment and buildings. In this entry, we increase the depreciation expense account by the amount of expenses allocated to the current months, and we increase accumulated depreciation account. The third one is accrued revenue. Companies often provide a service and then collect the cash. When a company earns a revenue before it receives cash, the company should increase the receivable account and the revenue account for the amount earned. The last scenario is accrued expense. Companies often incur expense and pay for them later. Interest is an example of incurring an expense before cash is paid. To calculate the amount of interest, we multiply the principal amount by the annual interest rate and by the relevant number of periods. After adjusting entries, the adjusted trial balance can be prepared. To summarize, the purpose of adjusting entries is to record revenue that have been earned but not recorded and expenses that have been incurred but not recorded. Every adjusting entry will affect at least one account from the income statement and one account from the balance sheet. Adjusting journal entries arise because the timing of revenue and expense recognition differs from the exchange of cash. Thank you for watching.